So new rules are coming out for MLI Select. So that's happening, and that's one thing. And then we also had the rate drop.
Yeah.
So two different things. What we're going to unpack.
Biggest change right now that I want to talk about, and we'll talk about the other changes. But the biggest one was that it used to be that you could do affordability, and affordability alone you can get 100 points.
They're trying to soften the blow of the pain to come. So it means they're kind of predicting some of that. And of course that pain happens, but it also relieves the pain for a lot of people who that rate is hurting them, and every little bit helps. So
what they have done though is they've actually released the 24-month hold.
Yeah, this is the biggest thing in my opinion, because a lot of people, especially in our world, go in private funds, they go quick, dirty, they get that work done. Welcome back to REI Hot Seat. We're getting more professional by the day. We now have a screen and a logo. The screen was there. This was always intended. We just finally got it going. So anyways, Jake,
Andrew,
welcome
how you
back.
doing? Yeah, thanks.
It's good. So we've had musical seats the last few episodes, and we are going to have Zach and David on a ton more. So it'll be a mix of all of us, sort of everybody who's in this office, talking deals, talking concepts.
No, it's great. And everybody's got a little bit different of take on everything, right? So it's really nice to have multiple people in here, you know, talking ideas, talking deals, how would they look at it.
But all investor focused and all multifamily focused.
Oh, it's great.
So there's actually been a lot that's been going on in the last week. So this one is, this will be the first episode since the new rules. Well, I guess it kind of happened like last Wednesday, but
but they take effect on the 19th.
Yeah. So new rules are coming out for MLI Select. So that's happening. And that's one thing. And then we also had the rate drop.
Yeah.
So two different things. What we're going to unpack. Which one do you want to take first?
Let's go rate drop, because there's only so much we can talk about there, right?
Okay, so rate drop. Rate drop, I think the first thing I'm going to call out is a quarter point is in actuality meaningless, but the sentiment effect of it, which I've heard this from other people. I thought of this on my own, and then I saw like 3 other people say it. I'm like, okay, I thought I was original. But no. Everybody's thinking the same thing. And quarter point doesn't do anything, but the sentiment is huge. Yeah.
Well, it's would I say huge? It's nice, right? There's a lot of people, like it's interesting when, you know, the day it happened, my phone was ringing off the hook, not for people wanting to buy, but people being like, oh, it's the other people want to buy now. Like that's the question I kept getting is like, oh, like, are you getting busy? Are people buying? And it's like, well, like yes and no, right? Like there's a lot of people going, oh yeah, like rates are coming down, right? But your qualification, let's talk res side first. Your qualification on the res, like,
it's not directly impacted. There's an indirect effect because on the residential side, you're qualified on the Bank of Canada fixed rate, which is based on the bond rate and the spread. So it's not directly impacted, but generally speaking, when the overnight rate drops, it will affect bond yields.
There's a trend.
Yeah, there is an indirect correlation.
The bonds have come down actually.
Yeah, the yield came down too, like after.
I've been watching the bonds every day, and I think today was the first day they actually came up a little bit. Yeah, just a little bit. But
today being Monday. This release is Wednesday. We're recording 2 days before. So
but you know what? Like it's obviously it's nice to see. It's good we're trending in that direction. It hasn't made a huge difference. I've talked to my residential broker friends, and they're saying, you know, it's still pretty slow out there. Markets, you know, a lot of opportunity. My fear is actually that because the rates came down slightly, it means everyone's going to list their properties, and I feel like we're gonna flood the market with inventory.
Interesting.
And it's like you said, it's not affecting the qualification. So the people that still can't afford it can't afford it. It's not like that 25 bips. All of a sudden they're up 100,000, 200,000 in buying power. Immediately. Eventually, I do think that will happen.
No, I think like so many people, and I saw this drop off like right around last May. So we're 13 months after this drop off, where it was like people finally accepted the rate environment and that it wasn't going to change, and it was like the interest in real estate investing started to fall off a cliff at that point. This would signal to me that people are going to be like, oh, okay, well, maybe it's time to start looking at it again. I don't think it's like run to my broker and let's make an offer, but it's like if the trend in the sentiment continues and there's that compounding effect of, well, now we think there's going to be 2 more rate cuts this year, which people are starting to say, some banks are saying, that could be the shift to start getting people to kind of people who were on the fence about really getting in to now decide to get in.
Well, and it's interesting because in the commercial world, I find the sentiment was actually a month ago, right now. Like, there's more people excited to buy right now than there has been in the last, 5-6 months, because they were all waiting for the bottom. Where's the bottom? Where's the bottom?
Yeah.
Right. And I think the definition of the bottom is right before the rate drop, right? The squeeze of the market.
Yeah. But the
but
majority of the defaults that would happen, say on the residential side, have not happened yet. Like
No.
the people, there's still people who haven't renewed. Like more than half have not renewed into high rates yet. That will come. And then the defaults follow that. So on the res side, which is a different animal, res and multifamily will behave differently.
Yeah. Well, I think res and commercial will behave differently.
Yeah,
Let's not even just call it multifamily, but,
Yeah.
and that's why, like, we've touched on the res. That's all I'm going to do, because I'm not a res broker.
Yeah,
right.
yeah.
So that's my understanding. Is my biggest fear is there's going to be people rushing to list their house because of the rate drop, and it might flood the market and make the scenario a little bit worse.
Yeah.
That's a prediction. Don't quote me on it.
Well,
Let's
I
see
mean, I
what
think you'll
happens.
see those like little yo-yo type changes, and then they correct back the other way, and like it all sorts itself out. I could see that though, for sure. Like in the well, it is a macro effect, and it'll happen in the short run, and then it'll just undo itself over time.
Yeah, and then in the commercial world, it's all bond driven, pretty much, right? Like, or at least the CMHC world is. Right?
Yeah, the CMHC world is funny, like because investors are always making a choice, and that's why it's bond driven, because the banks base their rate. Well, if we're going to lend it to you, we could just invest in bonds, but if we're going to lend it to you, we're going to get that premium. Their premium generally stays the same.
Yeah.
Then they just adjust with the bond rate, because they know the bond is always their alternative investment, and that's an oversimplification of what most investors are doing. They're always looking at their alternatives. What could I be investing if I wasn't investing with you? And you'll see that. You'll actually see that in conversation sometimes. Well, we could just leave it in the TFSA.
Conversation I have all the time.
People saying that?
All the time, right? Where do I put my money? Is it real estate? Is it, TFSA? Is it other lending avenues, stocks, bonds, crypto? Like, and it's, part of our conversation we always have is like, okay, well, can we take a little bit from here and go buy a building? Or can we take a little bit from the building and go invest in over here? Right? Like, and I think a blended portfolio is the most important thing when it comes to all that.
Yeah, diversified.
Right.
For sure.
But yeah, anyway, so like wrapping up the rate conversation, happy to see it.
It's a start. Yeah, I said the same. Yeah, I did. I had a midweek episode last week.
Yeah.
Happy to see it. I thought it was a good thing, because I want to see investors enthusiastic again. I don't like all the humdrum, like, poor me, I'm not going to do this anymore. It's potentially a milestone moment, potentially.
And I think people that are investors or thinking to invest coming out of this market, their mindset's a little different. Even if the rates drop, I still think people are going to be very conservative for the foreseen future. I think that will change once this is behind us and people forget about what went down. But
do they forget?
I think they do.
Interestingly, like Alberta, like speaking with good, savvy Alberta investors before all this, oh, you guys don't know what it's like to have a crash.
Right.
You know what I mean? Now Ontario investors can say, you guys don't know what it's like, but I mean, most people do. They won't ever forget, but whether it impacts them in the way that we've seen recently, that's different.
Yeah. Right. Yeah. And so, and in the commercial, we've seen the receiverships, the foreclosures, the bankruptcies. We've seen a ton of them. Like, we're dealing with a ton of them, and there's more to come. That's not at its end yet. So I think we're riding this out for the rest of the year. And I think we can look at, at the end of the year, I think we can sit back and have a really good analysis of like, hey, this is where we've been. I think this is where we're going. At this time, I'm not in a position to go out there and say this is where we're going. I just don't feel confident.
I think if you go on historical, when a Bank of Canada would do this, when a central bank would do this, they're trying to soften the blow of the pain to come. So it means they're kind of predicting some of that. And of course that pain happens, but it also relieves the pain for a lot of people who that rate is hurting them, and every little bit helps. So that part, again, very positive for people who their numbers have become tight. Hopefully this helps a bit. Yeah. And then the MLI Select thing, like, this is what people kind of switched gears to. The big switch, especially in your world, Jake, in the commercial multifamily world, was when normal buildings didn't make sense. A lot of people were either doing purpose built for MLI Select, or they're buying renos directly done for MLI Select. That hasn't really changed, right?
No.
Right. Okay. So let's talk about what changed. So the MLI Select program, this is an insurance program for CMHC to insure the lenders who lend to you. And if the lender's insured, they're willing to give you better rates. They're willing to give you better terms on amortization, and you, the borrower, pay for that. You are insuring the lender, protecting the lender. And if the lender's more protected, they play ball. They give you benefits. So
exactly.
Now that
so
we've
that's
explained
that's CMHC, right?
So we explained what CMHC does. Now MLI Select was a program specifically for multifamily buildings.
Yep. New construction, retrofit,
Yeah.
renovation.
Incentivizing certain things.
Yeah.
The things they were incentivizing were environmentally friendly,
Yeah.
like so low energy, accessibility in terms of handicap
Yeah.
and all that, and then affordability.
Yes.
So those are the three things.
Yeah.
So before it was a point system, and you could max out with environmentally friendly or
Yeah.
energy
So there's
efficient.
basically 0 to 100 points.
So you need 100 points
Right.
to get the full
And there's
50-year AM, right?
Yeah, and there's a 50 point, there's a 100 point. I think there was one other like bracket that no one really ever went after. But
Okay.
yeah, and so the main target, and these points programs gave you different terms of the mortgage, right? So amortization was one, loan to value was another, and your premiums went down as well. And then CMHC overall has better rates than your traditional commercial
you can get
mortgage.
into the fours still. Like actually now with the yields down, it's probably into like the sub
You're
4.5,
low fours.
low
Yeah.
fours now.
Yeah.
So you start running numbers at low fours, makes a lot of sense. I personally wouldn't really want to take the 50-year AM. To me, 50 seems too long.
Yeah.
But I would still take the low rate.
And this is a good conversation to have, because there's a lot of people, and I had this conversation this week. There's a lot of people in this market that are strapped and they don't know what to do. And the MLI Select 50-year AM, 95% loan to value, that's their safety blanket, right? And I'm guilty. Like I just closed on one that is 95% 50-year AM.
Yeah.
Right. I just did it myself. But you got to be careful of that. If your whole portfolio, if every building you own and you have 100 doors or 1,000 doors and it's all 95% loan to value, 50-year AM, like you don't have any equity. It's that you better have some serious cash flow.
See, here's my issue with it is that in 5 years when your renewal's up, like you've only paid off what? Like, and what if the rates have now gone up to like 8%? You know what I mean? The building that worked doesn't. I mean, hopefully that's not going to happen. And even if it did, like if rates went up that much, rents should follow.
Yeah.
Because now the alternative cost in living is going to go crazy. I don't know. Not a guarantee. I'm not Nostradamus or whatever.
But I think we're getting into the weeds, because I do want to talk about the program.
But we're getting back to the program. So the program, I mean, just to have access to the 50, that's pretty sweet. I would only just, to me, like it would have to be, I'd have to have a scenario where that really made sense to do. I'm not saying I wouldn't, but yeah, even 45, that would be cool. You know, something a little bit more in the middle. That would be me. But anyways, back to the program. So the program has changed. Now you can't get all the way there, what most people were doing with just going energy efficient.
Correct. So there's a whole bunch of little changes. Okay. But the biggest change right now that I want to talk about, and we'll talk about the other changes, but the biggest one was that it used to be that you could do affordability, and affordability alone, you can get 100 points.
Yeah.
Right. And then there was a green efficiency, energy efficiency.
And that could get 100
and that could get 100 points alone. Or it could be a combination of the two.
But now you need
Or you could sprinkle in some of the barrier-free accessibility stuff, right? Which was really only being used for new construction.
Yeah.
But you could get 30 points, 20 points with barrier-free. Then you could sprinkle in 10 affordable units, and then you could throw in some mini splits, and now you got a nice rounded 100-point program. But most people were just saying, well, what's the most beneficial for me? Well, doing mini splits and high efficiency lighting, right? Of course that's beneficial for me, because now as the landlord, I don't have to pay for the air conditioning or the heat anymore for my tenants. They're going to pay that on their own through their electrical bill. I'm also getting 100 points on the MLI program, and we're helping the environment while we do it. Right. So that was kind of the whole model that a lot of investors have been using over the last 2 years or year and a half.
Yeah.
However long this program's been out. And so the biggest change is that now the efficiency's gone. After the 19th of this month.
Now you can't get it with efficiency at all?
But you can only get half with efficiency.
Yeah, so now you
have to have a blend of efficiency with accessibility or efficiency with affordability. You can still get 100 points doing affordable.
Yeah.
But you can't do it with efficiency, which we knew was coming. Like, that was something that we saw coming down the pipe. There was way too many people just doing efficiency.
Did you say so you can get it all with affordability, but not all with efficiency?
Correct.
Yeah, okay.
So they're pushing the affordability angle now, right? So that's one thing, which is a big con if you look at, it's a big negative if you look at what a lot of people are doing. Now, saying that, what they have done, though, is they've actually released the 24-month hold.
Yeah, this is the biggest thing, in my opinion, because a lot of people, especially in our world, go in private funds. They go quick, dirty. They get that work done, but they don't want to deal with some institution that has all the red tape. They want to use private funds, and quite frankly, private funds are by far the easiest. They are expensive, so you have to be very careful with that. But me, having experience with private funds, I prefer that, especially with building and all that stuff. So now, like you could even raise it in P notes,
And they'll pay it out,
right? And they'll pay it all out.
It's a non.
They don't care. Before
VTBs.
So if you used it any other form of funding other than like their qualified lender, which would be like they have a designation, they're Ontario
there's a
regulated.
number of them, but
It's like a lot of credit unions and stuff like that. They just basically made it way easier to create properties that could go into that program.
Oh yeah, this is like this is actually different than what I was talking about, but
not needing the qualification on the lender.
Correct. That's one, but the other one is where you remember when they came out, it was randomly. They just threw it in the mix because they had so many applications on their desk, and they said if you're doing construction funds, we want 2 years wait after.
Yeah, exactly.
To
so you had
out.
to wait. So if you had done like a private lender, that wouldn't qualify. So now you'd have to wait the 2 years unless you
you'd have to go
them.
into a bridge, wait the 2 years in a bridge,
go into a bridge,
and then go into a CMHC. So yes, you're right in what you're saying, right? So but you don't have to wait 2 years, and you can use the private funds, the VTBs, which is awesome. Like
it's going to open up the ways that investors can get it done.
Well, because it used to be that way, and we'd just go in there. Andrew would give me a 75% loan to value VTB, and then I go get CMHC.
Yeah,
done. Right. And then there was no bridge. You didn't have to do all this because the fees on the bridge kill us. Like that's the expensive part. Right.
I think at the time they just had too many apps. They're just trying to
find a way to kill a bunch of apps. Right.
So they killed a bunch of apps by doing that, and then now they're probably geared up and ready to handle them again. It seems like my interpretation of what they've done is going to allow a lot more people to throw applications at them at this point.
Correct.
Because now all those people who are waiting because we need to wait the 2 years. Oh, we're good to go.
Yeah.
Throw in the app.
And so so there's definitely some pro with some negative to it, right? Obviously the efficiency thing was awesome. People loved that. But at the same time, like I was saying this the other day, you can go into a building now, right? And in some towns, it's just not going to work, right? Like Burlington. Burlington's a great example of a place that the efficiency or the affordability component is very tough to make
you won't be able to get low enough. Is it a national guideline?
No, well, it's per city.
Oh, okay.
Or you use the closest city nearby.
Yeah.
And or you can use the provincial one if you don't have a city.
There's some cities where it really, really works to do the affordability.
Oh yeah. So
doesn't it in Edmonton or something?
Edmonton, it works really well. So because what they're using is the renter market median or household income median for renters.
Oh, okay. Because
it's not household income, it's renter household income.
Yeah.
Right. And the median of that. So the challenge is, like, you look at Burlington. I think I just did the math with my mortgage with one of my lenders the other day, and it was, I think he said 1150.
My God,
is the number, because we have to use Hamilton or something of that nature.
Wow.
We were just spitballing ideas.
You're not getting
like
1150 for a 2-bed or a 1-bed.
It doesn't matter. It's 1150. You pick what.
So
you can pick bachelors.
So you're not
but even at
do
bachelors, you're 17.
So say I only get the 50 points. Like let's get to the heart of this matter, because a lot of people are going to be in that scenario. If I only get the 50 points, what does that do for me? Can I qualify for MLI at a lower?
The biggest differences on that are going to be your amortization.
Not going to get 50.
You're going to go 45,
which I don't want anyway, so I'm good.
Okay, and number two is you got to do a 1.2 debt service versus the 1.1. Which is the biggest difference. Like that's the catch.
That's the kids that'll stop you from doing the deal.
Yeah.
Well, right. I mean, the 50-year AM, the reason to do that potentially is it makes you debt service better.
Yeah.
So that would be why. Not that I want the 50. I mean, if I could accelerate it, I probably would. I might take the 50 and then accelerate, throw a little extra on it.
Right. But then if that's the case, like, and your premiums are higher, your fees are higher, everything like that.
If you don't get the full.
When you don't get the full one. So then in that case, do we just go look at traditional CMHC?
So traditional CMHC, you'd be limited to 40 years, right?
40 year.
But you still get the great rate.
You still get the good rate.
And then you'll have higher
fees. And you're a 1-2 debt service.
Yeah.
Right. You have higher fees, but there's less hoops to jump through. Right. So it's like, and we were just talking about this the other day in the office. We're sitting here and we're like, listen, the original program was a great program.
Yeah.
Right. Like it still worked. And if you can't make a property work with the original program, I still don't think that's a great buy.
Yeah.
Like the MLI Select was like the cherry on top. Like, hey, yeah, I can do this. I'm going to make this work.
If you
big.
play with the amortization numbers, and believe me, I have, like, it doesn't make that much of a difference. Once you go from 30 to 40, that's a big difference. But the difference from 40 to 50 isn't that much of a difference in the monthly amount.
Yeah.
Because you're just paying off so little of the mortgage.
Yeah, and play around, right? Like, is it, you know, what's your levers do you want to pull here? Are we talking about, like, is it down payment versus amortization, right? Like I was having this conversation with a family I work with the other day. Yeah. They have money. That's not the issue, right? But they want to make a sound investment, and they're actually, they are worried about leveraging too much, right? So with them, every time we look at a property, it's fun because we look at and I say, okay, well, what if we did a 35-year AM, but we put this down? Or what if we did a 40-year AM, but we put 60, you know, we do a 65% mortgage rather than an 80% mortgage, right? And then we find that fine tune that income amount with the leverage amount and the AM, and every deal we've looked at, we've had to play with it, and it's refreshing because they're not like, hey, maximize the AM, maximize the loan to value, lower rate.
I like being able to model something. You model it all out, and your levers are just those in my spreadsheet, the blue shaded boxes where adjust this box, like play with these until all the numbers are in a place where you're comfortable with, and then that's how you structure your deal.
Yeah.
So you don't have to take the maximum. You don't have to do like whichever. Do what makes sense for you. Yeah, for sure. Okay, so I think this is a good topic to cover because, I mean, at the end of the day, it's like, how does this impact me? I'm sure there's a lot of stuff in that release that probably isn't as big of an effect on people, but the big things we hit on.
Yeah, we just like, if anybody, listen, I have a sheet that basically highlights all of the changes that have happened. It's pretty dry if you want to read through it because there's a whole bunch of little tiny things that you don't see in the Instagram posts, right? No one's posting that stuff, but so it's tiny little like fees and this and that.
Is this an online like hosted sheet or is it a PDF?
Yeah, we can host it. Like I can put it as part of the link, right? So if anybody wants and they want to, you know.
Yeah, however you want to do it. If there's a way we can include a link to that, we can do that if people want to check it out.
Yeah, sign up to the link. I'll get you, send me an email or I'll send you an email. I'll send you a copy of it. Like, or I can even just make a hyperlink to that sheet. But, you know, it'd be nice to, if you're interested, you can read through it, you know, and then outside of that, like just keep track of the bond rates and see where the market goes.
Yeah, I mean, obviously as an investor, you got to be ready for whatever's going to happen, right? Like you're not just thinking today, you're thinking, okay, in 5 years, what's the market likely going to look like? How are we going to be making adjustments? How am I financing my deal at renewal? If you're CMHC insured, you still get the preferred rates when you go back because you stay insured for the life of the mortgage, right? So that's the nice part, for sure. So anyways, good summary for today, Jake. And you alluded to it already, but if people want to connect with you and the team, they can just enter their information into the link below. And that sort of puts them on a list where they're eventually going to get a call from somebody. Just reach out, say hi, see what they're,
guys,
what they're interested in.
Again, I'm happy to always talk about this, right? Go to the link, you sign up, you'll basically get an email and a call from one of our team members, most likely Megan. She reaches out, just says, hey, how you doing? You know, anything we can help you with immediately, right? What was the reason for calling? And please feel free to say, hey, no, I just wanted to sign up, right? Because signing up is also going to get you access to our deals. Right. It'll get you access to any of our, so in this case, we're going to get you access to the changes of the CMHC guidelines for MLI Select. And we just stay in touch. You guys get the newsletter, right? Any of our events we have, right? So we're doing the meetups.
Send those out. We are going to start those up again. Yeah. The big thing is just like, I mean, a lot of people who come into this, I mean, it's like sometimes people feel like they've learned what they need to learn and then they go away. We want you to stay in this world. So if you're on Jake's list, then you know you'll get the email about our next meetup or what have you. So
come down, have a cookie, have a cider, have a water, whatever you want, and we'll talk real estate
where we're doing it. But yeah, awesome. Okay, all right, guys. If you made it this far, show the channel some love, and thanks so much for your attention. We'll see you again next week.